Hi everybody and welcome along to the Mint Monthly Update for the Single Sector Funds. I'm David Fyfe and I'll be walking through the month of July as it was with markets. So firstly, I thought I'd touch on a couple of interesting charts here from friends at Jarden. And what we're looking at here is, how markets have tracked since the start of the cutting cycles. The chart on the left is looking at Australia and how it's performed, and then the chart on the right is New Zealand. But just sort of delving in first of all to the chart on the left with Australia. As you can see, versus other cutting cycles, the Aussie market's actually done reasonably okay. Having a look at some of the detail behind it, it actually sort of showed that certain sectors you'd expect to be more stable through a cutting cycle, like healthcare, has actually underperformed, whereas companies in sectors such as IT and technology have actually outperformed. So it's been an interesting one. And of course, there's the REITs and the ones that benefit directly from interest rate cuts as well that have actually done quite interestingly. But when we look at the chart on the right, as you can see in the red line, which is tracked sort of sideways, sort of shows that in terms of New Zealand as a market, we've actually really underperformed prior cutting cycles in terms of market performance. Obviously, a few different reasons for that, but really it is the sort of the weak macro. But partly it's also another reason why we are reasonably positive on New Zealand market, and we still think there's plenty of room for recovery and upside from here, from what has been a reasonably slowish start to the year. And just rolling over to the Mint SRI fund to begin with, obviously New Zealand market had a reasonably strong month, up almost 2%, which has been a reasonably strong start. In terms of the composition, it was very much a mid-cap benefit in terms of some of the names, including Ryman, a few of the REITs, as well as EBOS doing quite well, and then some of the large caps like Infratil and Healthcare being reasonably supportive. The main stock of focus for the month for us was actually, unfortunately, a negative contributor to the fund, but an interesting one here, and why I've got that picture on the screen, which was the Mainfreight AGM update for the first 17 weeks, which they tend to provide a trading update. Now, as you can see on the two circled numbers that I've put on the screen there, revenue was actually in line, if not, slightly up year on year with the expectations. So, obviously there's a bit of pricing there, but volumes in terms of commentary are pretty weak. But if you move to the right there, as we all saw and the share price reacted to, in terms of profit before tax, down 24% on what is relatively flat revenues. So certainly a very hard margin squeeze. Now, we did expect some of this to occur within the air and ocean business, which has seen freight rates come back reasonably dramatically from their highs, especially from prior into the year. Obviously, the tariff impacts from Trump. Seen a lot of uncertainty, and that has skewed through into rates and also, as we've seen here, in volumes. But I guess where the disappointment really occurred was around the transport and warehousing business. Both saw pretty significant margin decline, as you can see on the right there. And part of this is obviously just the deleveraging of lower volumes going through lower activity, while the cost base not being cut at the same speed. So certainly was a bit of a negative surprise to markets' expectations, and we've certainly seen since a few cuts to earnings for the year. While it doesn't change our long-term view on the company, it's certainly seen a little bit of rebasing, but one that we are still positive. But like a lot of stories, even as we've seen today with news out on Vulcan Steel and a few others, even ready mixed concrete, the recovery cycle within New Zealand and within global markets is still taking a bit of time. So one we're keeping an eye on, but we are hearing glimmers of supportive noise. We saw Maersk the other day update. And they're actually seeing rest of world perform strongly for them and the shipping lines, are more than offsetting their risk around the US trade impact and volumes. So it's been a reasonably strong one there. In terms of some of the stronger beneficiaries over the month, we did see Infratil perform reasonably well. Not a lot of news directly, but what we did see is the inclusion in the ASX 200 saw a bit of interest and some continued interest out of Australia in the stock. Our underweight in Gentrack was a reasonably strong contributor. Now, Gentrack did provide an update around a customer loss in terms of no longer being part of a pitch to a customer there. And again, this is a company that's been priced, in our view, not quite for perfection, but close to, and sort of hearing about a customer loss and effectively hearing a lot more about competition out of competitors like Kraken and a little bit in Kaluza, who have recently purchased Beige Technology, a CNI business in the software space. It is sort of being a bit of a reality check on the stock. We've certainly seen that come back a long way, and one that we're now sort of having a bit closer look at, but continues to do okay. And I guess the other one too was a bit of disappointment out of Serco. No news really in the month. I guess no news is sometimes good or bad, but for this month it was bad. And what we haven't really seen is any updates on how everything's tracking. Obviously, global travel has had some pressure at the moment with geopolitics going on. But in terms of Serco itself, we actually saw a re-update to their loyalty program, basically for business travel. This is allowing some of the consumers to get the benefits of loyalty from their business travel as well. So, some small positives within the platform for Serco and booking. We'll see how the next update goes from there, but one that keeps tracking along nicely. Within the Trans-Tasman Fund, another tough month for the fund a little bit there. I guess it was one story that drove it, and that was Telix. And this is a company that's had a bit of a roller coaster ride in the last 6 months. One that we quite like for a few different reasons, but obviously they did provide an update earlier in the month, and we did see, in terms of revenue numbers, reasonably broadly in line with the expectations. So a solid update from that perspective. But what did surprise everyone and caught everyone off guard was a subpoena from the SEC, which is really a fact-finding piece at the moment. But with Telix having listed on the US, slightly different requirements on different exchanges, and again, the regulatory authority there asking for a bit of information did spook investors. And unfortunately, negative news sometimes comes in more than one outcome and in pairs. And we did see an update from Telix just last week. Which was around the restatement of all their financials in US dollar, which makes some sense. But within that, they did provide a guide to OPEX as a percentage of revenue, which did surprise to the upside. Now, part of the explanation for this was around the recent transactions of some of their supply chain business, the RLS business, and it was a little bit higher than expected and certainly caught people off guard. So fortunately, the stock's been trading at a bit of a lull, but from us, we do see some positive catalysts and hence the chart in the pack. There's a few positives coming out. We saw, one of their competitors, Lantheus, coming out talking about a bit of competition in the market, but obviously almost implying that potentially that Telix is actually having a few market share gains. But on top of that, what we are looking for is a few updates around some of its products with Zircaix, expecting an update on that in terms of its diagnostic imaging product in late August, but also Gozellix as well, the updated product within the prostate cancer side, expecting that to see some approvals in late September. And yes, the 591 data, which is everyone waiting on as well. So there are some positive catalysts there. We certainly see the share price having fallen a long way. We did some back of envelope numbers looking at what we thought a fine from the SEC as a worst case could be. It was more like a sort of 20-30 cents rather than the $3 or $4 we saw fall on the day. So it is the name that we're still keeping a close eye on. And other names as well, we did see a bit of Mainfreight and Serco impact in the fund, but offsetting that was the overweight and Infratil, which continues to do well for the fund. Including this month, we've actually seen some updates even today around some expansion in one of the key assets of CDC within Infratil, seeing a expansion into Western Australia, which we look forward to seeing how that continues to support the wider business there. In the property side of the business, the fund, property had a really strong month, up almost 6%. It was across the board in a way. We did see some pretty good performance out of a couple of names in Kiwi and Stride, which helped the fund, of course. And part of the big one for Kiwi was around the ASB North Wharf asset. There was some risk that ASB, being the key tenant there, may look to move, and there was a somewhat bespoke building. So the fact they signed up to a long-dated lease has certainly de-risked that asset, and is a big positive for KPG on that front. Just the sector in general, looking at the top chart on the right there, the market's still trading at a pretty substantial discount to NTA. Across the board, it's around 17%. And I guess what this is implying from a pricing perspective, it's almost expecting 10% asset value decline across the board, it would be saying. And I guess the reason we are more positive is that, recent transactional evidence has kind of leaned on, some of the book values of these businesses being sold close to within some of the retail and industrial assets, is certainly not indicating this. So that's one reason why we think that, some of those valuations may have hit the floor and not be looking any worse, but still some skepticism in the market. And on top of that, looking at the chart at the bottom there, if we look at the green line in terms of how this cycle has performed versus other periods, it's certainly traded at a lot bigger discount and taken a while to recover. So for us, as we see interest rates flow through, we still think there's some strong supportive fundamentals around robust tenant demand, some modest annual renting uplift as well. And to be fair as well, with the high cost to build out there still, we see somewhat limited supply coming online. And we do have the reporting season coming up as well, with a couple of names from Precinct, PFI, and Vital, etc., coming out. And again, we expect to see some sort of marginal positives from there, from easing interest burdens through to some sort of stable occupancy as well throughout the business. So should be an interesting one there. And of course, reporting season does kick off this week in the wider New Zealand equity markets as well, with Vista this week, and then it all kicks off next week. And in general, it's sort of cautiously optimistic on some of the results, but again, it was really going to come down to what we see in terms of outlook. So it's how we fly through for the month of July and how we're seeing things. But as always, reach out to us at info@mintasset.co.nz if you have any questions. We can get in touch. Thank you for your listening, and again, get in touch if you have any questions. Thanks very much. We'll talk soon.